Hey friends, it's Iggy from the Investing Iguana. If you're like most Singapore investors, November's dividend calendar probably looks like a buffet. 29 juicy stocks dishing out payouts. But here's the catch. Most folks chase the highest yields, hoping for quick wins. The truth? Sustainable yield matters way more than big numbers alone. Let's walk through this together, almost section by section, and I'll share what really counts, and maybe a few personal tales along the way. So, what are we tackling today? We'll start with the big picture. Then I'll walk you through my November watch list. 4 stocks I'm actually eyeing. From there, we'll dive deeper into each: construction, property, semiconductors, and REITs. I'll also call out a few skip-worthy picks, spotlight hidden high-risk gems, and wrap with a guide for navigating all these choices. Plus, I'll show you how CPF and SRS can help you squeeze more income out of your portfolio. And if you're new here, I've spent years breaking down investing in Singapore so you don't have to stress. Let's start with what November actually reveals. This dividend season, construction stocks are booming, fueled by public projects everywhere. REITs are smiling as interest costs drop, letting them hand out more. And some steady industrial players keep marching strong. But here's something most analysts never mention. Dividend yield is actually a pretty lousy metric on its own. Imagine earning 4% yearly from a company that's bleeding out. That's much worse than collecting 2% from a business firing on all cylinders. Context, as always, is king. Now, after sizing up all 29 November payout stocks, only 4 really caught my attention for different reasons. These picks balance decent yield, solid growth, and risk that feels just right for Singaporean income chasers. First up, Lum Chang Holdings, a construction play that stands out in this season's dividend buffet. Check this. A 69.6% total return since January, absolutely thrashing the STI's 21.1% rise. What makes Lum Chang tick? Singapore's construction sector is riding a multi-year boom, thanks to mega projects like Changi Terminal 5 and MRT extensions. Lum Chang's top-grade contractor status means it's right in the sweet spot for big contract wins. The numbers: FY 2025 profit up 112% to $15.6 million and margins up by 3 percentage points. Even manual workloads have dropped 30% in optimized teams thanks to smart digital moves. That's the kind of operational edge I love. November brings a 2.17% dividend yield, with management more confident than ever about future earnings. Analysts are tagging a $5.25 of the target price, which suggests 14% upside from here. But let's not gloss over the risks. Construction cycles don't last forever, and labor shortages could eat into profits fast. One botched mega project and things turn ugly. Still, Lum Chang's cash-rich balance sheet and pipeline give me confidence in both growth and steady income. Next, GuocoLand. Some people love it, others shrug. The 3.33% yield is sweet, especially after a dividend bump this month. But here's where it gets tricky. GuocoLand is rooted in property development, a sector that's prone to wild swings depending on rates and regulations. Sure, earnings per share should jump 22.3% next year, and their payout ratio leaves wiggle room. But for me, it's more a bet on long-term Singapore property trends, and you need patience for those to play out. If you're looking for a reliable, boring dividend, GuocoLand is more roller coaster than bus ride. Then there's MicroMechanics. Now, I bet most retail investors haven't even heard of this one. MicroMechanics makes precision gear for semiconductors, and they've paid a dividend every year for 23 years. The upcoming ex-dividend brings a 1.71% partial payout, but there's more. Their governance is stellar, ranking among Singapore's best managed companies. Dividends over the years have stacked up to 134.9 cents per share since 2003, so if you bought at IPO, you'd be smiling real wide. Recent figures are impressive. Profits leapt 54.2% this past year, driven by strong demand. The only caveat: earnings may dip a touch next year, and the payout ratio is already on the high side. So, if you want steady income and exposure to Singapore's chip sector recovery, MicroMechanics is worth a look. Finally, Mapletree Pan-Asia Commercial Trust, your classic REIT anchor. REITs always draw heat in Singapore, and Mapletree Pan-Asia leads with a 5.5% forward yield. Their November payout splits into two, 0.3% and 1.05%, respectively. Here's what's neat. Their portfolio covers prime, commercial, and retail assets all over Asia. Sure, their dividend per share has dipped a bit. It's down 10% from last year. But don't panic. Lower financing costs are now kicking in, making future distributions more secure. For the big income chasers, S-REITs provide real stability as interest costs ease up. Just remember, office and retail sectors face their own pressures. AI-driven changes or e-commerce shifts, for example. But if you want monthly income and solid diversification, Mapletree Pan Asia deserves a slot. Let's take a breath here. If you want all the tables, details, or even a checklist, everything's on Substack. The link's just below. Zooming out to the ones to watch that I'm skipping. Wing Tai Holdings pays a modest 2.1% yield, but fundamentals are shaky. Unprofitable, yet still shelling out dividends. That's just not sustainable. Top Glove, after bouncing back from 2 tough years, pays a tiny 0.72%. The sector is still exposed to price swings and currency risk. Tyson Electric is predictable. 2.6% yield, steady growth, nothing too exciting, but definitely solid. Now for the risk takers out there, the overlooked picks. Lum Chang Creations is the wild child, a spin-off laser focused on urban renewal and heritage builds. It's got a fat order book and promises a generous payout ratio for the next couple of years. But slow down, this is a story stock. No track record and patchy revenue streams. You're betting that management grabs enough big contracts and keeps their payout promise. For me, that's speculation, not true income investing. OSEA International looks tempting with a 4.99% yield, but most revenue comes from Taiwan, and trying to analyze it from Singapore is like reading tea leaves. Opaque, conflicting data, loads of risk. High yield might mean hidden trouble. Ellipsis throws a 3.45% yield your way, but operates in everything from semiconductors to property to chickens. Yes, chickens. That randomness makes it impossible to value well, and recent profit gains came from asset sales, not real business growth. The dividend isn't well covered either, so it's for pure speculators only. So here's what this whole dividend calendar really tells us. 3 themes jump out. Construction is king this month. That confirms our infrastructure cycle thesis. Just remember, cycles peak. Don't put all your eggs in one hard hat. REITs bounce back as financing costs drop. Great for retirees and income-focused portfolios. Industrial stocks show mixed results. Some, like MicroMechanics, surf big trends, semiconductors. Others are stuck in choppy waters. Now, thinking about how to approach November dividends? Simple. If you're conservative, stick with proven brands. DBS remains the gold standard, even though it's not on November's list. Among the current crop, MicroMechanics is best for reliability. If you want growth with income, Lum Chang Holdings is a good bet. Construction tailwind and all. For maximum yield, consider the REITs. Mapletree Pan Asia beats most. Know the risks before you dive in. Feeling adventurous? Take tiny positions in story stocks like Lum Chang Creations. It can be a thrill ride, either big wins or big size. One angle most investors miss: tax optimization using CPF/SRS. Use your SRS funds to build a high-yield portfolio. Dividends received in SRS are tax-free. When you retire, only half of your withdrawals are taxable. A huge plus. Or for younger investors, the CPF investment scheme lets you use your ordinary account to invest in selected stocks. With CPF rates steady at 2.54%, you're already ahead, but maybe you crave more. If so, pick only top names you can hold through market storms. Of course, with every opportunity come risks. The yield trap. High yields often mean trouble. Don't get tempted by a 7%er from a weak business. It's a path to losses. Dividend cuts sting, especially when they come alongside falling share prices. Diversify to buffer the pain. Capital loss. Dividends look great until your stock drops more than you're getting paid. Focus on total return, not just yield. Tax surprises. Singapore treats dividends kindly, but foreign shares can bring nasty taxes and currency headaches. Always check before buying. Okay, action plan time. Mark these weeks. Late October brings ex-div dates for Wing Tai, Tatseng, and Lum Chang Creations. Early November gets busy. GuocoLand, MicroMechanics, and a bunch more. Mid-November, Ellipses and ASL Marine close things out. End of November wraps up with Tyson Electric and Top Glove. To lock in payouts, buy before ex-div dates, usually 2 days ahead. So here's my bottom line for November 2025. There's something here for nearly every investor style. Construction names riding a wave. REITs enjoying lower interest costs. Selective, industrial plays with real potential. My own picks balance yield, quality, and growth. Lum Chang Holdings for construction with income and upside, MicroMechanics for steady dividends and top governance, Mapletree Pan Asia, commercial trust for reliable REIT income, and GuocoLand for property exposure, if you're patient. But my honest take, dividends are only one piece of the puzzle. Overall returns come from price appreciation, sound businesses, and strong management. Build a diversified portfolio, keep an eye on fundamentals, and rebalance often. Income today is nice, but real wealth comes from choosing companies that can grow and thrive for decades. That's the kind of dividend, call it lifetime yield, every investor should chase. So if you're mapping out your next move, here's what I'd keep in mind. Focus on quality, diversify, and don't chase yield blindly. Got questions? Drop them below. I love hearing your views and debates. By the way, if you want all the reference tables, checklists, and written breakdowns, they're on my Substack. The link is just below. And if you've enjoyed this walkthrough, consider joining our premium community. You'll get early access, inside conversations, and a tight circle of fellow Singapore investors helping each other out. Hope to see you on the inside. Oh, and if you want to learn more about picking REITs for monthly income, check out my next video linked right here.